Okay, so this morning I'm gonna do a really quick valuation. Shout out to Kenshin, who gave me some really valuable feedback. He said that he wanted to hear me kind of walk you guys through the process, and so I'm just gonna throw on some music, jump through the valuation process quickly, and let's get into it.
Are you serious? Are you serious?
Okay. So honestly, I'm gonna have to do a little bit more digging to see if GitLab is related to GitHub, if I'm deploying code whenever I'm writing a website, let's say. GitHub is something that I use, and so if any of you code, then you know what I'm talking about. I just have no idea if GitLab is associated with GitHub, and so I'm kind of impulsively valuing this company without fully knowing what it is, which is never what you should do. But I just want to see if this is worth the price that's up here. So $24 a share. Okay. So this thing IPO'd back in 2021. And so off the bat, my investment decisions get split into two categories. The first is going to be lifetime holdings. Lifetime holdings are companies that I completely understand in and out. I understand all of the competitors. I understand all of the ins and outs of the business as it's broken down by the company on their annual report. And I feel like the business, feel is the wrong word because that's emotion. I've determined that the business possesses a durable competitive advantage. That's some characteristic about the business that keeps competitors out. I've thoroughly listened to the management, reading their reports, listening to their earnings calls, watching them on interviews, and sorry, I always have to listen to
Are you serious?
the same thing on repeat. Or else I break my focus. And so, yeah, there are specific criterias that the business has to pass through in order to be considered a lifetime holding. That's what's going to give me the confidence to hold on to the security, which is what a stock is. It's a security. And no matter what the market is doing, if it goes up, if it goes down, I've thoroughly thought about the business in a way that gives me comfort holding it despite what the price is that the market is saying it's worth today. I mean, if you look at this chart, the same business is worth 10% less today, 25% less than it was worth a month ago, 40% less than it was worth 3 months ago, almost 60% less than it was worth a year ago, and 70% less than it was worth in 2021 when it IPO'd. And so traders, speculators, they're looking at, let's say, $77 a share when it IPO'd. And then, a month or two later, it went up to $125. And they're trying to figure out what they could buy at $77 that could go to $125, and then they try to sell it by predicting if it'll drop. And so they play that game of buying low and selling high by trying to predict the lows and the highs. And then they have these strategies to stop the losses if they're wrong and it's going down. The value investor plays a whole different game. They understand that the stock or the share is just a contract that gives you a percentage of ownership of the business. And so the business is generally the same business. Of course, business things can happen like mergers, acquisitions, and things like that technically change that, but we don't have to complicate it for now. All of these companies around us, you know what? I'm complicating it. I always go off on these tangents, which kill me. But it's all relevant information, so technically you should be consuming it anyway. But one of the basic principles for the value investor is that they're buying the business. And so as this price bounces up and down, it's either going up, down, or staying roughly the same. And the business is either overvalued, undervalued, or fairly valued. And so the two categories that I was sort of discussing earlier, lifetime holding versus something called a cigar butt, which is, you're walking along the street, you need a smoke, you don't have any money in your pocket, and so what do? You start looking around the ground and you find these little cigar butts, and they might be dirty and they might be soggy and they're kind of disgusting, but if you dry it with a lighter and you spark it, you might get a free puff out of it. And so value investors look at cigar butts kind of like that. And the way we spot them is you have a business that maybe doesn't meet all of those qualifiers that I was breaking down earlier to figure out if you could hold the thing long term, but it's so statistically cheap that the low price is probably not going to stay that low. In that scenario, if it does go lower, that's generally an opportunity to us to buy the same thing for less. And so that's how we think about this whole thing. The more you watch these videos is the more clear it's going to be, because this process is very specific. And so you're going to be able to figure out what the rules are and what the framework is for making these decisions. It's the same framework. And so, okay, to me, when I look at this, I see a 70% discount. But I want to know if $24 a share is undervalued, fairly valued, or overvalued. Now, just before we proceed, one more thing I want to touch on is the lifetime holdings I kind of went into. Is it something you understand? That's one. Is it a business that contains or possesses a durable competitive advantage so that it keeps competitors out and you can have a strong business over time? That's two. Have you got an idea of the honesty and the ability of management? 3. Don't overpay for the business, which is what we're getting into here. 4. And is this the best overall opportunity considering all those same filters? 5. Those are your considerations. If that thing that you're looking at, for example, GitLab, if it passes all of that criteria, then that's considered a lifetime holding. That means that over the course of the future, as share prices fall, if the fundamentals of the business, the integrity of the business remains the same, then that's your opportunity to buy more of the company for less. And so our view as value investors is that eventually all of the value investors will soak up positions in the company's stock, and so that it will stabilize and orders will be placed within the market that just cause it to rise in a way where the speculators usually spot it, and then the speculators will start to carry the price upward because they're trying to gamble on the price, buy low and sell high. And so they keep doing this trading type behavior that tends to drive up the price, usually to a point that's completely irrational and not in line with the actual value. So what we're going to get into here is determining the value. To me, I don't fully understand the business. I don't understand what advantages it has that would keep competitors out. I haven't learned anything about the management at all. We're literally just figuring out the valuation. And so at best, let's say I realize that this is a product that I know and understand. At best, it's a cigar butt. So let's figure out if it's even a cigar butt. Wow, what a tangent. Okay, so the first thing we're gonna do is we're gonna take that's called the ticker symbol, GTLB. We're gonna go to the Securities and Exchange Commission website, which is the part of the government that oversees the market. This is where companies have to file reports continuously through the year so that the investor, you, me, anyone, has publicly available information so that they're informed. So I think it was GTLB. Now, I was doing this and then I realized I should probably make this video since this is what Kenshin wanted. So, report of proposed sale of securities. That usually means that they need money for operations and they're selling more equity in the business to raise the capital that they need for operations. That's going to dilute your value as the investor. If anybody wants to know, like, how, why, or you want an explanation, I'll get into that. Okay, so, by the way, 10Q is quarterly. 10K at the bottom here is annual. So every 3 months they end the quarter.
Are you serious?
You'll see 3 quarterly reports, and then the 4th quarter they don't release another 10Q, they just give you the 10K, which is the annual report. This is the first time that I've ever seen a report where they don't have an address and it says not applicable. No phone number. I've never seen anything like that. And they're a large accelerated filer, meaning they're not a small company. Okay. Over here, it seems like they have two classes of stock, Class A and Class B. I like companies that have just one share of common stock because to me it's easier to value. When you look at the shares on the exchange here, this doesn't say, it does say that it's a Class A. We can actually do a search, Class B, GTL. So there's no B share on the exchange. So I don't know if the B share I don't like situations where I have to scratch my head. Sometimes the companies break it up where the different shares get different voting rights. And so Mark Zuckerberg talked about this once where he said the way that they have the shares arranged, he holds on to the voting power, and so they really can't get rid of him.
Are you serious?
And so not all companies operate that way. Let's, just for mathematics, assume that you have 150 million shares here of the A, and then you have 20 million shares of the B. And so 150 million plus 20 million, that's 170 million. We're gonna round that up to 200 million just to make the math easy in the head. And I'm gonna show you in a second why it's okay to do that. If we round up 200 million shares and then multiply that by, we'll round that down to $20 a share. The way that I do the math quickly in my head is I just slide the decimal. Instead of $20, I'll say $2. Because if 200 million shares multiplied by 2, that's easy, that's 400 million. And then if you slide the decimal back from 2 to 20, you get, instead of 400 million, you get 4 billion. And so $20 a share times 400 million shares, I'm sorry, $20 a share times 200 million shares is, like I said, 4 billion. The reason that's significant is because the market cap is almost to a T 4 billion. So the math that you're calculating there is, okay, I know what it costs to buy one share. You know you can buy 1 share, 2 shares, 10 shares, 100 shares, 1,000 shares. Okay, well, there's only a limited amount of shares available. We calculated 200 million. So that means if you know you could buy 1 share for 25 bucks, that means that you can buy all of the shares at that price. That's the math that you're doing in your head. And what it does is it stops you from just focusing on the bouncing share price, Because if you were to take all of the shares off of the market, there are no shares to bounce around in price. It changes the math that you have to do. Okay, if that's not clear, I'll try to make it clear in another video. But the way you determine if it's worth the share price is if you say, okay, if I buy all of the shares, what am I getting? That's actually it. That's it on the money. Okay, so now that you know that it costs $4 billion to buy all of the shares, what are you getting for $4 billion? So this is the quarterly report. I think that that's what we're in, right? So the first thing that we're going to look at is something called the balance sheet. The balance sheet shows you the balance between the assets and the liabilities. Assets are the things that the business has that helps them make cash. It could be buildings, office equipment, inventory, all of those things, cash in the bank, all of those things are needed for business. In the process of accumulating those assets, most people, most businesses have to take on debt. Just think about it as if you take out a mortgage so that you could buy your house. Okay, you're going to pay that debt back and then you have the house left over as the asset. So when you take the assets, add them all up, then you take out all of the liabilities, the debts, you're hopefully left over with a balance of equity. So down here, first you're looking at the balance sheet. And like I said, assets, liabilities. Okay. At the bottom, you're going to have something called stockholder equity. Assets minus liabilities equal total stockholder equity. Now, this number looks like it says $967,997. This number is actually in thousands. And so if that's 997,000, this whole number is actually 967,997,000. So again, I love mental math. We're going to round that up to $1 billion. If you have $1 billion in equity, we're then going to look at the assets that you can't just easily take and sell on some sort of marketplace for cash. If you have office equipment, you can liquidate that and convert it to cash. If you have, company invoices where you're owed money, you could technically sell that off to another business, and a business will buy it if they think they could convert on those invoices and collect cash. Okay, there are certain things that are not easily convertible to cash. So under assets, the first is going to be goodwill, and the second is going to be intangible assets. They literally tell you that they're not tangible, they're not physical. And so here you have, we'll say 17 plus 12, that's 29. So 29 million we're going to take out from, 268 million. $268 million minus 29 million. Oh, my bad. 968 million minus 29 million. You have 939 million in assets. Okay? So a lot of the times you'll see companies inflate the goodwill amount, the intangibles amount, so much so that once you take those out, you actually have negative equity. The good thing is that you still have roughly $1 billion in equity. So right there, that's telling you that if the business is worth $4 billion, according to the market, but has $1 billion in tangible equity, it's only worth 75%. It's worth 25% of the price that it's currently selling at. So just off of that alone, we can take, $25 a share times 0.25. If that thing goes to $6 a share, which is 1/4 of 25, then that's the asset value. So you can see this stock price go down from $24 in one day all the way down 75% to $6. There, if you know the business, you could feel comfortable buying it, except we're next going to look at net income. So we looked at their balance sheet. We're going to look at, they're pulling in revenue, they have a whole ton of expenses. Are they left with money after tax? Because if not, any year that they lose money, they're actually going to start to deplete this cash reserve that they have in the asset column. For example, if they lose $1 million this year, that $1 million is going to eat out of their cash and cash equivalent balance, because where the loss is going to come from. If you make $1 million in profit, you can throw that into the bank and then it'll be part of the cash pile. So this is just a quarterly, but you've got, in terms of total revenue, you've got 244 million. Yeah, this is the quarterly report because this is just 3 months.
Are you serious?
But if you're making, 250 million, let's say, every quarter, you're making $1 billion a year in revenue. And here it is. Net income. They lost 9 million. Compared to the same quarter the year prior, they made 28 million. So, just for the heck of it, I want to look at, first off, you should look at all of the quarterly reports to start to get a picture of what's going on there. But this here is the 10K, that's the annual report. I know I'm all over the place with this. My bad. Okay. KPMG. One of the big four. I don't know if it's still, is it still big four? I don't know. But we're gonna take a look here. 228 million in cash. 34 million in goodwill and intangibles. 34 million. So roughly, if they have 821 million in equity minus 34, you know, you're looking at roughly, I don't know, $785 million. So they've built on their equity position since then. Now, these are annual figures. In 2023, 2024, and 2025, their revenue has increased substantially, actually.
Are you serious? Are you serious?
Now, by the way, when you're looking at this sheet, you can see how that trickles down. Okay, revenue, you have subscriptions, some licensing revenue, total revenue, and then they have the cost of that revenue. So right here, 675 million in revenue only costs them 65 million to obtain. That's really, really an amazing margin. Those are huge margins. The licensing, it's roughly, I don't know, 12% or so of their subscription revenue. So this part of the business is really, really small in comparison to the subscription business. Wow. Out of all of this total revenue, the cost of that revenue is that. That's amazing. Operating expenses. Okay. So in order for the company to operate, you've got sales, marketing, research, general and administrative. Okay. Huge operating expenses. You have to, you're either making interest income or you have interest expenses. They have interest income. Other income. This is the importance of reading the report, because you're not going to know what any of that is until you read the report. Loss from equity method investments.
Are you serious?
Phew. If it's in parentheses, it's a tax benefit. If it's not, it's a tax expense. Their taxes are all over the place. And no matter what, in the end, they are not making money. 2023, they lost 182 million. 2024, they lost 430 million. And 2025, they lost 9 million. That is why they have to sell more stock. It's because they're losing cash. You know, for example, if they have another year where they lose another 400 million, yet they only have 200 in the bank, that's a problem. They have to raise capital. Some businesses, Apple for example, net money and add it to the bank. So they're draining cash. and they're selling equity, which dilutes your position. If this were $6 a share, it's entering cigar butt territory. Listen, they might be just growing the business, obviously, because look at how revenues are growing. Maybe that's why they're pricing things to stay competitive, gain their market share, but I don't understand anything about this business. That's the importance of reading the report. And that's the reason why I would put this in the cigar butt category as opposed to the lifetime holding category. It's still overpriced. Now, that's not to say that today, tomorrow, someday in the future, it isn't going to go from $20 a share to $200 a share. It could.
Are you serious?
But in this case, that would be speculation. It would be people just buying it because they want to gamble, and then if it goes up, they sell it, then somebody else buys it with the same intention. If it goes up, they sell it. That's how bubbles form. Hopefully this was an educational breakdown for you guys, but this is how we look at every individual stock, and that's a bit of the thought process. If you're not going through that thought process, you're speculating. A lot of thought has to go into the decision. When something is an absolute no-brainer, it flies through all of that analysis, and that's how you know whether to put your money into something or not. Thanks for watching.